Hello everyone, welcome to C.A.S.H. Today we'll continue the topic of terminology used in balance sheet. In part 1, we have already discussed plant and machinery, furniture and fixtures, investments, loans and advances. Today we will try to cover inventory, debtor and cash equivalents. In balance sheet, we use the word inventory, also the word stock. But what it actually means, today we will discuss. Inventory is the word derived from Latin and it is pronounced as inventarium in Latin word, and it means list of things, which means in company we list out the things we have in our godown. For example, you have heard the word of stock audit or inventory count, which means we count every inventory, whatever we have in our godown, how much stock we have in what quantity, what batches, like that. So listing of the things is called inventory. So then why it is called stock? What is the difference with these two? Stock means raw material, work in progress, finished goods. We call these as stocks. Whatever the company produces or manufactures, that is stock for the company. But whatever the company sells, those are all inventory. For example, think of a company which manufactures televisions. So the company which only produces or manufactures television, for that company, the TV is only its stock. And think of it, the manufacturing company only manufactures TV but won't manufacture its packing material like thermocol, cardboard box, etc. Now it can't sell its television without protection. It must pack its production or finished goods. If the TV manufacturing company won't produce or manufactures any packing materials itself, then the TV only its stock, then it has to buy or purchase thermocol for protection and cardboard for packing the TV from other companies. So now thermocol and cardboard also this TV manufacturing company's goods, but this TV manufacturing company separately it won't distribute these thermocols and cardboard box because this TV manufacturing company only purchased these things from other companies. All this together is called inventory. Whenever the stock audit or inventory count is taken, then the company will count all together. Not only the manufactured TVs, it also counts thermocol and cardboard box. That is why it is called inventory. So stock means your production only, but inventory includes your stock plus its packing materials, which helps to store production or protect your productions. Now we will discuss about the debtors. Debtors are also called trade receivables, which means we have traded something and we have yet to receive something. That something is called amount or cash. For example, a person has made sales to XYZ Limited, not a person, the company has made some sales to another company called XYZ Limited. Now this ABC Limited has given time for XYZ Limited payment within 20 days of this sales, which means from the date of sales, it has given 20 days time for this XYZ Limited to make or fully make the payment. Now this XYZ Limited can make payment to ABC Limited on the sale date or it can make on the 20th day. So why this time is given? Think of it like this XYZ Limited on that sale date may not have such money to pay to ABC Limited. So ABC Limited will give some time for XYZ Limited so that within this period XYZ Limited can earn some money and repay to ABC Limited. So because of this, ABC Limited will grow up and its reputation will also go up. But this is not loan because you are not giving money to XYZ Limited, but you are giving only goods or services to XYZ Limited, where you are giving time to make payment, but you are not giving any amount and telling them to repay that amount. That is the concept of loan. Now here only you have given goods or services and you are giving time for the debtors to repay or make payment within such period. Why they are called debtors? They are called debtors because they are indebted to you. But why they appear in asset? Because you are yet to receive the money. When it is receivable, it will be asset to you. And in accounts, all assets shows debit balance, so called debtors. They are indebted to you to pay your money. This is like loan, but you are not giving the money, but you are giving the money in the form of goods or services and giving some time to make such payment. If you observe, the company will not expect any extra return from the debtors. Why? Because while you are selling your goods or giving some services to the debtors, you have already added your profit. So no extra returns will be expected from them. Now, cash equivalents. You know what is cash? A legal tender from the government. You can keep it in your hand or at your bank. These are real money. But what are cash equivalent? Cash equivalents are same money but invested somewhere to earn extra income within short period, that is maximum 3 months. So wherever you invest, it should get matured within 3 months. What are the conditions for calling cash equivalents? It should be highly liquidable, which means whenever you want the money, that day or by the next day, or you can also say T plus 2, transaction day plus 2 days. Within these days only, you must get your cash. Liquidable means convertible to cash. Highly liquidable means very quickly convertible to cash. If you have invested somewhere and if you want to withdraw your money, then that withdrawal should happen within T plus 2 days. That is called highly liquidable and no major price fluctuations. If you observe share market, there will be high price fluctuation. Market goes up and market goes down every now and then. But that should not happen in this case. It should be almost steady, almost risk free. Here risk means the fear that you lose money. If you invest in share market, then you may incur some loss. So this incurring loss is a risk. In here, since it is cash equivalents, it should be almost risk free, which are negligible loss, maximum tenure. It should be matured within 3 months. For example, we can say treasury bills, certificate of deposit, commercial papers, and etc. Why cash equivalents when you can earn income from SB account or FD account? Companies are not allowed to open savings account in bank. So there is no interest portion here. So we got the answer for SB account. They must use current account for day-to-day transaction. But current account won't pay any interest. That's why even if you keep 1000 crores in current account, they won't pay even single rupee as interest. If they keep in fixed deposit, then the company can't withdraw it whenever they want. As the term says, fixed deposit, which means we have to keep the money at least for 1 year, 5 years, 10 years, like this. But the company can invest in fixed deposit minimum for 6 months, not below these days. Because of these reasons, they invest for such a short term period to earn income on that investment, and they can withdraw whenever they want. In upcoming parts, I will try to cover equity and deposit. Part 3. Today, you understood why inventory is more than just stock, why debtors are actually future cash, and why cash equivalents behave like almost cash. If this helped you understand this concept clearly, make sure to like, share, and subscribe. If you have any doubts, comment it below, and I'll see you in the next part. Thank you so much.